Hello and welcome to the Weekend Investing Daily Byte of 27th of September and a good close to the week that has been quite eventful. We've made new highs on the Nifty unexpectedly this week, but all has ended quite well. Today's discussion will be if SIPs will falter ahead the way we are going. We have a very nice study which is showing you how in certain scenarios SIPs may not be the optimal situation, and in other scenarios SIPs will be the best situation. So we will discuss all about that. But first, please try to subscribe to the channel. Where is the market headed? The market is in a very strong position. We've now gone from nearly 24,700 to 26,200 in a matter of days. Today, the market was at complete rest after four good sessions. Last Friday, we had a very strong up move right here, and we've continued on that for five sessions. And today was a session of rest, I would say, minus 0.14%. FIIs have come back very strongly in the month of September. I think they have now invested more than 50,000 crores. So FII is coming back strongly. DII is still continuing to invest. SIPs continuing to carry on. Liquidity is no issues for India market, and that is causing the markets to gradually go up. Nifty Next 50 Junior was extremely ecstatic today, almost 1% up today. So this has really outshone the Nifty movement today and closing very strongly. This week itself has created a 1800 point gain on the Nifty Next 50 index. Mid caps continuing the sluggishness, minus 0.03%. So, like we've been talking since many days, mid cap and small caps versus large caps seem to be not very enthusiastic, as it at least as of now. If we get a new wave of bullishness there, it will show on the screen. But for now, it seems like mid caps and small caps are in a consolidation mode. Small caps also losing 0.19%. It's only in very longer trends will multi-cap uh, funds shift from the mid and small cap gains that they've had. So the problem right now is that most multi-cap products would have a lot of mid caps and small caps and less large caps. So even while large caps are moving up, they will replace mid caps and small caps to some extent only if that rally continues for some time. And that we'll have to see for some more time. Nifty Bank finally sort of giving up on this relentless run that it has had today. So, in fact, today's session minus 1% on Bank Nifty has erased almost the entire gain of this week. So last week we were here at 53,700 something, and we went to nearly 54,500, and we've now recovered or come back to exactly the same point. Maybe we will come back and take the support, test this breakout support once again next week. But for today, Bank Nifty down 1%. Momentum trends in the top 500 stocks almost even. Uh, you have 263 declines to 232 gains. FIIs again clocking 600 crore positive for 26th, and DIIs have suddenly started accumulating more in the last 3 or 4 sessions, and also the yeah, MSCI rebalancing flows have to close on 30th. So that is another event that is coming up that will possibly have some skewed numbers from FIIs. Reliance taking the lead today while HDFC Bank was dragging the market down. So HDFC Bank, ICICI Bank, Kotak Bank all down more than 1.5%. Reliance stabilizing the market with 1.8%. What you need to note here is that Coal India, BPCL, ONGC, these stocks were up. So there seems to be some bottom to oil and energy stocks here. Sun Pharma, Cipla also doing well in the pharma space. Titan up 1.5%. Bharti also down, which had been running very hard. Power Grid down 3%. L&T down 1.5%. So many stalwarts losing some gains today. Nifty Next 50, as I mentioned earlier, extremely bright green today. Um, Even the uh, public sector enterprise stocks, HAL, RECPFC, GAIL, all gaining good ground. IOC up 5%. You had Pidilite, Indigo, Torrent Pharma, TVS Motors, Vedanta Limited, Geofinance, Siemens, Bosch, all gaining ground. Adani stocks lost ground. Varun Beverages lost ground. United Spirits, Godrej. So FMCG in general, along with DMart, Zomato, all losing ground today. DLF also losing some ground today. So the mixed bag, but yet Nifty Next 50 doing quite well. In the sectoral trends, public sector enterprise stocks clocked 1.5%. So a little bit of a shift of situation here. Public sector enterprise stocks have been at the receiving end, and today some gains coming there. Still, on a monthly basis, they are still reeling at minus 1.1% along with PSU banks. So public sector entities along with public sector banks have been the worst performers for the last 1 month. What was losing? Of course, private banks lost the most. FMCG down 0.5%, real estate down 1.2%. And you had also commodities and pharma gaining ground. So suddenly, again now, on a correction day basis, shift towards the laggards, and the ones that were pulling ahead have seen some sort of correction. Within the oil and gas segment, you can see here that some sort of a base formation has happened and a new leg up has started. BPCL, IOC, Oil India, HPCL, all leading the market up. I think crude oil and in general, commodity space is looking good also. Within the specific stock movements, Sri Renuka Sugar was up 10.2% today. This has been consolidating for 3-4 months. Also, news of sugar shortage and drought in Brazil is causing sugar stocks to look up. This is looking extremely good from a chart perspective. And above this 53 level mark, we may see a massive rise going forward. Although on a very long term basis, Sri Renuka Sugar has not really gone anywhere. Of course, on the recent last 4-5 years, we've really gone from 3 rupees to 53 rupees, which is amazing. But we've also had a past of going from 100 rupees to 3 rupees. So, as long as you're staying with the trends, as long as you're staying with stops and a proper strategy, any stock is a good stock. Will the SIPs falter ahead? Is the topic of the study today. So, just in general, if we see uh, where Nifty could be, if we have a 8% CAGR from here on in the next 20 years, we could reach 1,21,000 mark. At 10%, it will be 174. At 12%, it could be 2.5, and at 14%, it could be 3.5 lakhs. Now, imagine this is the kind of a variation that can happen because of difference of CAGR compounded over a long period of time. So you can see on the chart, we could end up in this zone by let's say 2044, and essentially we will need to estimate where we land, although there is no certainty of any estimate of that kind. So this study that was done by uh, Anurag Singh from Ansett Capital in ET Prime. I'm taking this study here. So 10% annual returns on Nifty projected over 21 years, starting from 2020 is the base of the study. So by 2040, there are three opportunities to double your money, 12,000 to 24,000, which has already happened. So from 2020, we've already more than doubled. Then the next doubling, of course, from 24 to 48, and then 48 to 96 is the projection. The SIP journey for first 10 years has been split into two phases. So accumulation phase and next years is the growth phase. Market movements, however, are not linear, and all SIP studies assume the perfect world of consistent increasing CAGR over 20 years. And this is where these assumptions, when they fail, SIPs may underperform. So this beautiful chart sourced from NSE is showing three different scenarios where Nifty goes from 12,000 to 96,000 at about 10% CAGR from 2020. And over 5 years and over 10 years, over 15 years, different trajectories of the Nifty have been assumed. So the red trajectory is where you get in the first 10 years a lot of growth, and then the next 10 years is slow. In the blue territory, you have amazing accumulation phase for the next first 10 years, and then there's a sort of an exponential growth. And the brown or the black line is that of linear consistent growth across. So what has been claimed is that, if the blue curve, which is this curve, is actually the ideal curve, where the first many years you are accumulating the SIPs, and then the growth kicks in, so that your accumulated capital gets the benefit of that exponential move. And sometimes you will see a a red kind of curve where uh, your input SIPs in the first 5 years are minimal, because you're gradually accumulating SIPs over this period. But the most of the move has happened already in the first 5-10 years. So by the time your amount comes in, gets and starts getting compounded, the move is has flattened out for the next 10 years, so that won't really help you as much. And this, of course, is the ideal sort of uh, linear move that happens. So now what is happening is that uh, this constant growth curve, I mean, if we see from 2020 and we are in 2024 already here, so we are somewhere very near this between red and black curve, where the first 4 years, or even if we reach, let's say, 27, 28,000, uh, we are closer to this red, of course, to the linear line, and of course we are very far from the blue. So folks who have started SIPs from 2020 uh, won't sort of benefit as much as those guys who started SIPs, let's say, in 2016-17 period, where the first 4-5 years was not anything great, but then the next 4-5 years have been great, or even earlier than that. So the idea that is being presented here is that the first half of your journey, if you are able to get lucky that markets do well, but they don't do as well as your next 10 years, for instance, then the hockey curve kicking in, the exponential compounding kicking in happens for you. For instance, somebody invested, let's say, 2010 onwards. And so 2010 to 2016-17, their SIPs would have accumulated without much gain, but that amount would have compounded really handsomely post 2018, 19, 20 till now. While it's difficult to say how the next 20 years, how the next 15 years will play out, but if the market continues to go in this ferocious manner in which it is currently going, then obviously the new SIP guys will not benefit as much. In case our final destination is going to be the 10% growth, in case our final destination is going to be 15-16% CAGR, then there is no issue at all. So I hope you can appreciate this point, that early market growth followed by tapering off of the market is going to lead to poor results for SIP. So the net corpus, uh, uh, here, the corpus that you accumulate initially won't be as much, but here, when you initially accumulate the corpus, it will have a longer flow, so as to go. I mean, if you just see here that by 2030, if you've put in a significant amount of money here, I mean, the next 10 years growth isn't as much as what is happening here. It's almost tripling from here, and here it is going up only 50% of the time. So I think you will get the idea here, that even though the destination of the index is the same, but your journey of putting in SIPs at different trajectories of the market is going to make a difference in the outcome. So those who have come later to the markets in the last couple of years probably uh, will sort of have a better chance if the markets consolidate for some time and their SIPs continue to come into the market. Um, India's story is ongoing. I mean, it's developing for decades. There is no issue as such. We can, of course, at some points of time, move far ahead of where we should be, and sometimes even lag where we should be. So stagnation for some time can benefit also, certain parts of the market, but then those who have come in much earlier, will get impacted due to that stagnation. So we have to need to be prepared for any kind of situation. We really can't say that, if then the last 5 years Nifty has gone, from 12,000 to 26,000, not even 5 years yet. The next 5 years would be similar. It's very difficult to say. It could well be. I mean, nobody can rule it out. But then there may be situations where, you get 2, 3, 4 years of consolidation, and then you may have another burst. So, like you can see, there's a burst, then there's consolidation, there's a burst, then there's consolidation. And this time we've had very steady up. I mean, there's not been a burst as such like these two instances. So maybe this will turn into a burst, and then burst in this in the sense of the word, I'm saying bursting upwards, not as in a balloon bursting. So maybe we get a burst in the next year or so, and then we get this kind of a consolidation for a few years, so that we come back to the trajectory that we have. So again, no right or wrong answers here, just acclimatizing you to the fact that blindly sipping is, while it accumulates wealth, no doubt about it, but the impact of that accumulation is best if that accumulation happens in periods where the market is not running away. And many other markets have seen that kind of accumulation and, gradual recovery. So that's the discussion for the day today. Do comment in the YouTube comments about your thoughts on this and on the trajectory you think markets will take. And I'll see you next week. Have a great weekend. Thank you so much. Bye bye.